Say you sell this, right? Well, actually, let's do spot and for tomorrow. So if you do that and then move it down here, you're not super profitable on the downside move. Like you needed to drop to like 54.50 to make 20% profit, right? But if you widen it out a little bit, you can move that break even up, right? So say you sold like the 65.80, you're much more profitable faster, right? So like that means like kind of drop even right now if you dropped to like 54.50 or that same break even, you'd make 10% more on that decline. And then like as time goes on, obviously as that approaches expiration, that profitability improves, right? And then, drop to 54.50. So like it was a 0 DTE midday, but the profitability at 54.50 would be like 60%. It's almost double. Whereas if you narrow that, it goes down about 10% per strike. Let's go scooping up flattened pennies in front of a steamroller. Well, no. I mean, it's not necessarily pennies in front of a steamroller. Like, if you really think it's going to go down, right, and you're selling calls into something you think is going to go down, right? Like, if you think it's going to go to 54.50, you would just sell the 54.50, buy the call at spot, right? Because then your credit is going to be more comparable relative to your spread, right? So you're gonna get a higher credit because you're selling the call in the money, and then even if it drops to like 54.60, you're making like 14%, right? And not even the move you want. And if you drop to 54.50, you're making 40%, and the money you make is greater, right? Like you're making on a drop to 54.50 on that spread, you're gonna pick up you're gonna be able to close it for 540 less than you spent to open it. You sell these when you think they're not going in the money. Like the five wides. These are not directionally well, they're not very directionally biased, right? So you're selling that spread assuming that the market has topped or is going to fall, right? But it's not going to go any higher. If you think the market's going to reject, you want to sell, the in the money call, not the out of the money call, right? Because this isn't going to do shit. It's going to stay like the same price until expiry. And then, then you take on that like end of day risk. Anyway, yeah, that was the fun stuff. So SPX moving into the upper market maker expected range, just barely, like outside of the MM's expected range by a few points. Looks like the MM expected like around 54.65 today. We ended up closing at 71, but decent move up. Still well within the expected range though. I'd say closer to like the SPX expected range than SPXW. But a bullish bounce. We did leave behind a bit of a gap to the downside. I would say that there's a decent chance that we see a continuation of this tomorrow into the data, and this should change expectations a little bit. Obviously, futures has yet to break to the upside of its descending trend. It showed a little bit of weakness earlier and is retesting now. That might break in the overnight, and we could push up or gap over some more resistance to the upside going into tomorrow morning if bulls continue to push overnight. I don't think we have any big overnight data for them to leverage. We have like balance of trade out of China, and unless that misses by a significant degree, I don't think that'll matter. The 5-year JGB auction might, and British unemployment in the morning could have a big effect on the dollar, especially if it continues to rise. Right now, the forecast is 8.7, current is 8.4. That could do a little bit of damage to the pound, which is up quite a bit against the dollar still. Is Britain okay? Maybe not. And having other like G7 countries fall into recession is not a good look for the US, right? Germany's inflation rate is also projected to go negative, which is not good either. So a bit deflationary there, but their year over year is still slightly above 2%. I would say if Germany comes in lower than expected or Great Britain's unemployment is really bad, or I'm sorry, 4.2 to 4.2, not 8.7. I was reading a different thing. Yeah, if Britain's unemployment is really bad, or Germany's in deflation or deflator is really bad, those could both have a pretty outsized effect on moving the dollar to the upside, and maybe the JGB bond auction, but I don't know if that would or not. It's a 5 year, so it could have some effect on the top end. Anyway, yeah, I mean, I would watch this overnight. If it does gap up overnight, it's probably going to gap up to the 55.34 level, where it would find maybe some resistance. Bullish breakout, I really need to adjust this, is really like 55.62. At this point, I would consider us in a reversal. So a break above that, well, at least moving towards a reversal. The long-term test is pretty important too. So I think all three of those levels should probably be watched pretty carefully, but incrementally, more and more bullish as price moves up. Commodities turned around a little bit today. Looks like oil finally found a floor. Precious metals moving back up. So is copper, but agricultural commodities falling, kind of dampening the overall growth for the day. Dollar up quite a lot, 42 points. Yields at the back end of the curve declined pretty sharply after rising on Friday. The yield curve, however, is still uninverted or positive. The 210 is still positive. Correlation broke down a little bit today, but mostly stayed fairly stable. Doesn't look like they're leveraging up the dispersion trade right now, which is maybe something to watch out for and might be not a positive for tech. People are getting scared out of short vol, and bond funds are going long vol convexity. So that's not great for short vol sellers, right? It makes selling vol very, very risky because you're fighting back against the portfolios of the entire bond market. Carry trade got levered up a little, mostly on the top end. Still looks like 3 and 6 month are in a decline. I guess 6 month is starting to turn around a little bit. Forward yield on volatility now at 4.72%. If that goes back below zero, that's probably a signal that those bond funds are going to drop that vol hedge, especially if it goes below zero for any significant period of time, and that would be the first marker of like a bear rally. So watch out for that, at least on the vol side. Correlation trimming down alongside. Well, kind of flat vol in bonds. Looks like more tail risk hedges are being picked up on this bounce though, which could be slightly indicative of greater fear than currently being projected by price action. I would keep an eye on this as skew increases. It means people are going longer out of the money puts. 43.14% of the S&P above its 20-day moving average. Looks like, sorry, out here on the 1 week, correlation between VIX and VIX futures, up a little bit from the prior week. But if we go out here to the daily, that spread is starting to widen. So we are still getting quite a lot of short vol since our big spike back in early August. It's not widening very much, though. It's not so much so that it's barely noticeable. So not significant, at least not yet. Fed fund futures pricing in like 50 or wait, sorry, 0.05 fewer cuts for Fed than they were earlier today. Just on the back of like the few little economic prints we had. That's slightly more bullish. I mean, anything that reduces the pace of Fed cuts is going to probably be viewed as being bullish right now, right? Because the slower the pace of Fed cuts, the more likely we are to be heading for a soft landing. The more rapid the pace of Fed cuts, the more likely we are to be headed towards a recession. Today caught a bounce, but we did not manage to test the 200 EMA or MA on SPX here. I'm sorry, the 50. The 50 and the 30 EMA and the 50 MA are kind of lined up. They're both right around 55.05 to 55.10. I would expect that if today's bounce were to continue tomorrow, that would be that would be an important target for that test. Now, we can pull back, retest the 50, and then fail. And that is actually probably more likely right now than an actual bullish breakout. This kind of looks like a continuation. This is a very weak bounce relative to the downside price action, where we lost 2% over 4 days. So almost 4% decline in the index. I think maybe it was a little worse than the 4.5% decline. And today's bounce back only 116 points. So this is not a good look, and it's going to continue to be a struggle for bulls until they're able to get back above delta neutral, which is around 55.50 right now. That may be getting closer to spot. I'll update you guys on that tonight in Pickles Picks. Anyway, I hope you guys enjoy the rest of your day. Thank you so much for tuning in. For anybody who's part of the Gamma Strike beta, make sure to check your emails for your payment links and ensure that your refund has already processed. You can search Gamma Strike if you're having a hard time finding the email, or check your spam and promotions folders. Thank you guys so much. I'll see you later.